Imagine this. You walk into a shop. Everything is cheap. Too cheap. Candy, toys, even houses. At first, it feels amazing. You buy more. Everyone does. But slowly, the shop starts falling apart. Shelves break. Quality drops. Fights start. That's what happened to the global economy. Not because of greed. Not because of laziness. But because money became too cheap. Microhook. What if the thing meant to save the economy is the same thing that broke it? Let's start simple. Money has a price. That price is called interest. Interest is like rent. You pay it to borrow money. When interest is high, people think before borrowing. When interest is low, borrowing feels painless. Now rewind to 2008. The global economy crashes. Banks fail. Jobs disappear. Governments panic. So central banks do something extreme. They slash interest rates. Almost to zero. Visual metaphor. A big red price tag on money drops to nearly nothing. The idea was simple. Cheap money equals more borrowing. More borrowing equals more spending. More spending equals economic recovery. At first, it works. Happy. Businesses borrow. People buy homes. Stock markets rise. Everyone claps. Microhook. But cheap money has a dark side nobody talks about. When money is cheap for too long, it changes behavior. Not slowly. Structurally. First problem. Bad businesses survive. Normally, bad companies die. They can't repay loans. But with cheap money, they keep borrowing. And borrowing. And borrowing. These are called zombie companies. Visual metaphor. Cartoon companies with tired eyes being dragged by IV money bags. They don't innovate. They don't grow. They just exist. Second problem. Assets explode. When money is cheap, investors search for returns. So they pour money into houses, stocks, crypto, anything that moves. Prices rise. Not because things are better, but because money has nowhere else to go. Character expression. Shocked. Homes become investments, not places to live. Young people get locked out. Microhook. Cheap money didn't make people rich. It made things expensive. Third problem. Risk stops feeling risky. When borrowing costs nothing, failure feels harmless. Companies gamble more. Governments borrow more. Debt piles up. Visual metaphor. A tower of blocks labeled debt, wobbling higher and higher. Everyone assumes rates will stay low forever. They don't. Then, inflation arrives. Prices rise everywhere. Food, fuel, rent. Central banks panic again. But this time, they do the opposite. They raise interest rates fast. Cheap money disappears. And suddenly, reality hits. Zombie companies collapse. Stock markets fall. Housing slows. Governments struggle to pay debt. Businesses cut jobs. Worried. The system wasn't built for normal money anymore. It was addicted to cheap money. Visual metaphor. An economy character shaking as the money supply is pulled away. Microhook. This isn't a crash. It's withdrawal. Cheap money wasn't evil. It was a painkiller. Used too long. It hid problems instead of fixing them. Low productivity. Bad incentives. Too much debt. Now the bill is due. The real lesson? Economies don't break suddenly. They break quietly. Over years. Through temporary fixes. Pause beat. If you understand money, you understand power. And if you don't, someone else decides your future. CTA. If you want more simple explanations of how the economy really works, subscribe, because the next decade will be shaped by everything we just talked about.